Welcome, and thanks for joining this short walkthrough on ESOPs and private company wealth. In the next few minutes, we will unpack how employee ownership can create liquidity, preserve culture, and build long-term value. And I'll guide you through key structures, tax strategies, and practical steps companies use to implement ESOPs successfully. Between 2020 and 2022, we saw a sharp rise in leveraged ESOP formations, nearly 299 new plans, and the fastest pace in 2 decades, as this chart shows. The main drivers are owners seeking liquidity without selling to outsiders, and a desire to preserve company culture, which in turn fosters employee ownership and stronger engagement across the business. When companies consider an ESOP transaction, they can sell a minority stake, say 30%, or transition fully by selling 100% to an employee trust while taking fair market cash. Owners can remain as CEO or phase out gradually, and governance typically stays with the board, so the business continues to operate without external interference during the ownership shift. An ordinary stock sale triggers capital gains tax, but Section 1042 can defer or even eliminate that tax when sellers reinvest proceeds into qualified securities within the prescribed window. This rollover unlocks tax deferral, allows proceeds to compound in new investments, and supports long-term estate planning, while converting sale proceeds into future wealth rather than an immediate tax bill. Academic meta-studies show ESOPs with high involvement cultures outperform peers because shared decision-making and an ownership mindset boost performance. On average, ESOP firms see about 2.3% faster annual sales growth and roughly an 8% higher profitability margin, highlighting that when every employee thinks like an owner, innovation, engagement, and financial results improve together. Scorp ESOPs bring a distinctive tax advantage. The trust-owned share of an SCOR corporation is exempt from federal income tax, effectively creating zero federal tax on that percentage. That freed cash flow can be used to service buyout debt, fund business expansion, or be reinvested to raise share value, turning a tax benefit into meaningful operational flexibility. The financial impact of employee ownership is tangible. Median ESOP account balances hover around $175,000, roughly double the typical 401k. ESOP participants commonly earn about 33% higher wages, and household net worth for participants can be nearly 92% greater than non-ESOP peers, demonstrating a strong link between ownership models and long-term wealth creation. For mid-market employers, ESOPs offer a recruiting and retention edge because zero-cost equity and enhanced job security distinguish the employer in tight labor markets. The ownership culture effect typically reduces turnover by about 25%, which in turn slashes recruiting fees and stabilizes teams, making it easier and cheaper to attract and keep talent over time. Implementing an ESOP is a staged process that starts with feasibility analysis, valuing the business, stress testing cash flow, and modeling trustee financing, then moves to launching a minority ESOP if EBITDA can cover debt service, and finally scaling ownership as performance rises by linking share allocation to growth and profitability so ownership expands in step with company success.